we must recognize that while equity is very exciting and it's a growth area, debt is still the largest part of what the average saver holds, and therefore it's important to look at that very carefully. Often we sort of do the equity allocation and look at debt as the sort of whatever's left over. You have to look at debt with an allocation view the way you look at equity. When you look at equity, you may today look at some amount of large cap, multi-cap, index, sectoral, etc. So we look at that quite scientifically now, I think many investors do, in spreading it across different styles, different types of market caps. It may be similar to do that in debt as well. First is the liquidity bucket, which is money that you keep aside just for the near term. You don't want to take a lot of risk. This is money that is largely represented through the liquid funds or the cash funds or the overnight funds, which is near term, which is safe, it is available on tap, and that's the very simple purpose of that allocation, right? Emergency cash or just money parked away for easy. The second bucket is what I would call the core bucket of your debt investment. And this is money which you want to be safe, which means that, it has to have the highest quality of assets, and it must try and manage interest rate risk to the best way it can match your investment time horizon. And the third bucket, which is what we would call the alpha bucket, or where you can take some risk, and in that bucket you can get extra returns either by taking position or taking calls on credit. In many cases, what we come across is that people may have not thought about the buckets as clearly and taken risk while thinking that it's because it's debt, it's all very safe. Keep in mind, debt can also have risk. And one has to be careful and conscious about what's the level and nature of the risk that you're taking. If it's a smaller allocation in your portfolio, one may say no harm done, across the cycle it comes back. But if that becomes the largest part of your allocation, then you have to question that, make sure that when you come to debt, you're looking at the allocation right. If you were to choose to walk into credit risk, one must be very clear that that's the nature of risk you're chasing. At the headline level, it seems like that's an interesting trade or an interesting thing to do, but one must be careful about that because, there's a reason why someone is demanding that higher interest rate from these companies. So we would say, keep your money safe in debt, stick to AAA, stick to near term. If you want to take risk, be very careful about that allocation in your portfolio. And that to us is probably the better way to look at your debt portfolio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.